flopping between negative and positive. Not too much of direct leadership, visible. And banks were a problem for the market yesterday as well. Let's get the heat map up. So it's neither here nor there. You don't have too many, major pulls on the downside, but you don't have too much of leadership also. So therefore, there you see, it's almost a 50-50, even Steven kind of a screen. Net neutral, but the bias is slightly negative for the time being, and the Bank Nifty holds the key. Bank Nifty for the time being is down about 100 points.
Well, from the broader markets, a few stocks actually are calling for your attention. The ones that are doing really well is Tilaknagar Industries. Well, the stock is up close to around 10%. Management sounding extremely optimistic. Volume growth in Q4 was very, very strong. The street likes that. So that one's up close to around 10%. Vascon Engineering, well, the numbers look very, very good. They've gone ahead and for a 1,000 crore market cap company, they've raised close to around 45 crores via selling a stake in one of their, ventures that they had. So that's around 4.5% of the market cap. So that's why that stock is up. Finally, the numbers coming up. Remember, the stock has come off big time from the top. Other couple of stocks that are doing quite well today. You have Lurch Avenue is Tech. Well, that stock, in fact, is up close to 4.5%. I think it came out with a good set of numbers. So that's one stock that's moving well. Sri Renuka as well is moving up on decent amount of volume. So good move out there. Piramal Pharma started up gap up with a gain of close to 4%, but that's given up some part of the gain as we speak. The ones that are under pressure, I think Bazaar Style Retail, the stock is down 7.5%, so some selling being seen out there. Which other stock is coming on the radar? You have ADF Foods that's down close to around 5%. I don't know what's gone on there. And Dam Capital, remember it listed, it had big gains, but from the top, actually, the stock has got slammed. And I think it came out with its set of numbers. The street maybe were expecting more because the stock is down close to around 4.5%. And Karnataka Bank as well, I think we highlighted earlier.
Yeah. Muthoot and Karnataka seem to be the two result disappointments so far this morning.
Well, Eicher Motors has opened in the red. So despite in-line numbers, the stock is down close to about 1%. Numbers were in line, but valuations are expensive for Eicher Motors, and Eicher Motors is spending on growth. So margins are perhaps, according to some analysts, could get impacted as the company is now investing for growth and spending for driving growth. So Eicher Motors in the frontline pack is the one which a big move. IndusInd Bank is down over 1%. On the way up, you've got strength in JSW Steel, Hero MotoCorp. These are the only two stocks with gains of about 1.5%. On the way down, we spoke about Muthoot Finance. The other one is Karnataka Bank. Disappointing set of numbers. The NII has contracted. The stock is under pressure. Sagility is the other one. Again, stock reacting to numbers. On the way up, I think Sharda Cropchem had a positive tick early in trade. Very strong numbers. Revenue growth of close to about 6.9%. 39% revenue growth. Volume growth was about 48% in the agrochemical segment. The herbicide segment was also an outlier with a revenue growth of 57%. So strong numbers. And Apollo Tyres, we thought the numbers were a bit subdued relative to peers, but Apollo Tyres has actually opened up in the green. So that's the other one bucking the trend.
Okay, all right. So quite a few of those result reactions continue to play out. Overall, though, it is a far more cautious morning than what we had yesterday. Yesterday, right from the morning, the mid-caps were doing very well. But today, it's a little more measured at this point in time. So let's see how this plays out. Large cap screen, the losers include an IndusInd Bank, Dr. Reddy's, ONGC, M&M Eternal. So it's really mixed. It's across the board today. Not very clear sectoral trends coming out, at least so far.
Some of these railway stocks like Texmaco Rail, Ircon, I think are still continuing, extending their rally.
From yesterday, yeah. So that buzz is still on. And watch for sugar, Renuka and Bajaj Hindustan, both seeing some buying as well. All right, we've got Tahir Badshah joining in. He's our market master of the day. And of course, he is from Invesco Mutual Fund. Tahir, thank you so much for being here with us. So, the market's had its hurrah moment and it's been a fabulous comeback from those early April lows, right? The question really is now what next? Because now we're back to asking about the micros, about things like earnings, till the flows come back in a big way. So when we talk about those core fundamentals, which is earnings and valuations, how are we poised after this strong pullback in April?
I think before, we saw this market once again start to kind of recover significantly over the last 6 odd weeks. I think what we had seen was roughly about a 10% correction in the valuations of large caps and probably close to about 12 odd percent on the mid cap indices, and perhaps more closer to about 18-20% as far as the small cap index was concerned. From there onwards, of course, we've seen a rally, and good part of it is probably covered. So I would assume that still compared to, let's say, December 31st levels, which were where the market's probably peaked. We still probably have some valuation decline. But meanwhile, like as you rightly said, I think the focus after many of the other clouds having cleared over the space of the past few days has shifted to earnings. And on the earnings front, I think what has come out so far seems to be quite nice to see. And probably that should impart some support both to the strength of the market as well as overall valuations as well. So I think what we've seen up until now, whether it be in the large cap space, mid caps as well, there's been a fairly strong delivery of earnings. We are still halfway through the earnings season, but by and large, in terms of representation, probably about 70 to 80% of the market cap in each of these three buckets is probably now already through, and we are seeing roughly about double-digit kind of growth at an aggregate level. But mid caps have done stunningly well with probably a 18 odd percent growth, if I'm not mistaken. That's what I probably saw at an aggregate level. Small caps have trailed, but partly also on account of commodities and metals. If you strip off that, it is still single digits. Not too great, but nonetheless, I think it takes away a lot of risk as far as expectation on earnings is concerned, and particularly compared to the September and December 24 quarters.
Tahir, hi. Morning. Rima here. Is there a real risk that money moves out of India into China? When you speak to other investors who have that option, is there going to be the tactical switch?
It's quite likely. I think even before probably the last week that we saw climb down as far as U.S. China trade tensions were concerned, we felt that at least I was of the opinion that probably this time around, when flows return to emerging markets, there will be a fair bit of China too will be a reasonably decent beneficiary, unlike, let's say, over the last 2-3 years when generally India has dominated the scene. And that's thanks to probably, DeepSeek at one level, and probably the realization over a period of time that the Chinese economy is trending somewhat differently compared to what it has traditionally been. Traditional sectors have started to kind of look a little more, stable, real estate, infrastructure, their own domestic consumption. And alongside which it is now probably being viewed from the lens of, an economy which is reasonably tech oriented, whether it be in the form of things like artificial intelligence, automation, robotics, medical automation, etc. So I think the complexion of that economy is changing, and probably global investors would be inclined to look at least some parts of the economy from that lens, which perhaps is a place where India probably does not provide them that opportunity or exposure. So I think it'll be India plus China in terms of flows as we go along, and especially if emerging market flows improve on an aggregate.
Okay, all right, Tahir. Good to see you after a while, Tahir.
Thank you very much.
How would you position yourself, though? Because the domestic interest is back now. And over the last few days, you've suddenly seen that the broader markets are actually doing well. And the point you made that earnings haven't been as bad as expected. So as of now, would you be tilting towards the mid and small caps that actually took a hard hit? Or would you stick to the large cap names?
So, Nigel, actually, we didn't really back off from the mid cap and small cap space as much over the last some time. We've been through the thick and thin, and we also probably were not in the camp where we believed in terms of taking those cash calls and stuff like that. So I think generally we don't do that under most market circumstances. So I think that has kind of probably helped us to recover quite quickly, especially in this recent rally. So at our end, I don't really think there's been much of a change. At the margin, probably I would have thought that our mid cap and small cap exposures would have only gone up in the recent few weeks or a couple of months. We continue to ideate out there. We continue to probably find pockets of interest, either growth oriented or probably value oriented. So I think we are pretty much there, when we probably have only gained at not having actually disrupted the balance of our portfolios despite the volatility in the market.
Tahir, for mid caps, obviously it's usually always bottom up. But in terms of a theme or, some sort of a segment within the mid-cap or small-cap arena, is there anything where you see clear visibility, something that excites you right now?
I think basically at one level we are probably a little more positive on NBFCs, for example, to some extent. That is where we probably find opportunities in the mid-cap space. Few pharma companies, that is something which also probably is interesting. Some of the industrials have actually also done well, both in the mid-cap, in the mid-sized market, as well as some of the larger cap names have also done well. More particularly, we all know defense has actually made a roaring comeback. So even there, we have a few mid-sized entities as well. So I think these are some of the areas which I believe have where we have probably increased our exposures. I think mid-cap tech, especially in the more recent decline, has also offered some opportunities. Maybe not as much on mid-cap, perhaps mid-cap as well as some small caps too. I think have also helped us out there, and that is an area we have looked at least from a valuation standpoint or a value standpoint, especially after the correction which happened post April 2. So I think these are the few spots where we probably have added to our exposures and weightages.
Okay, and what
Sorry,
about
just one question. On mid-cap tech, is it the IT services companies or would it be some of these ER&D companies like a
It's
KPIT
largely
tech?
been the IT services company.
And you would go back the high growth ones? Because there the valuations are relatively
They have
expensive.
been, they have been sticky. Valuations have been sticky, but delivery has been reasonably strong in some of those names. So we've continued to back some of those. Perhaps some of the, as we've gone down along the tier, some of the small cap entities have also probably taken our attention. And it's not as much because they've done well in the last quarter, but looks like at least that they've had specific factors which have affected them. Probably looks like the worst is behind them. Some trends which are emerging, which seem to suggest that the next few quarters should turn out to be better. And then, of course, valuations have been supportive. So I think that is where we have basically set our sights.
Got it. Final question before we let you go, Tahir. I think real estate was a pack that you liked, earlier.
Real estate, right?
Real estate, yes.
Yeah,
You're
okay.
maintaining a positive bias, and if you could tell us at least geography-wise, where you're more bullish.
So I think so I like real estate and especially after this correction, I think real estate is an area which I would still prefer. I think as we see decline in interest rates, that should be further supportive. By and large, from a more structural standpoint, we believe that this sector is still in its relatively early stages. I would say we have another 2-3 years to go at least for the cycle to hold itself. We've not necessarily gone by geographical preferences because quite a number of the companies that we own have their anchors in certain specific areas, locations, whether it is south or north or perhaps east. But largely, we've looked at them from a perspective that which are the ones which, if they try to become pan-India players, should be relatively easier for them to do so and should be able to extend their presence in other locations. So that has been the driver, that has been the driving theme as far as a stock selection in this space is concerned.
Okay, all right. Final question on consumption. Y'all be leaning towards discretionary, I think so. Are you changing that around?
Within which I think we would have probably, altered a few choices. Noting the fact that, we are probably likely to see some deceleration as far as urban-centric consumption or discretionary growth is concerned, and a pickup on the other side as far as rural is concerned, or perhaps value retail is concerned. So there would have been some shift in that regard. We would have added to a few value retail, segments, and probably also a few of them which are basically in things like QSR, etc. Once again, a little more tier 2, tier 3 driven. So that's where I think our incremental choices have been. But once again, it's a fairly decent mix. At the margin, we have probably moved more towards some of the value retail stories.
Tahir, it's interesting you mentioned QSR. I was looking at numbers of Westlife, came out with numbers, I think, yesterday. And even companies like Jubilant, finally, those numbers have started looking up after many, many quarters. So the entire QSR space, or this restaurant space, food space, so to speak, how are valuations here? Now the numbers, the earnings seem to be catching up. At least they're not as bad. Is there a further runway ahead? Because we all know the big talking point, of course, has been this additional 1 lakh rupee in the hands of people thanks to the income tax cut, and whether that is going to boost demand further. What's your sense?
So obviously, valuations are not of the type which are mouth-wateringly cheap. But basically, I think quite a number of these names have been at the bottom end of their business cycle itself over the last 2 years, primarily because a larger part of the incremental growth in many of these do come out of the non-urban centers, and the non-urban centers have probably been a little, slow over the last some time. But things are probably likely to change. Perhaps if we get a good monsoon, interest rates are already coming down, inflation is coming down. That probably gives a little more space for discretionary spends to go up in the mass segment of the income pyramid, and that is probably what will drive incremental growth, if at all, for some of these QSR companies. So that is where we are basically laying our bets and trying to play that segment.
Tahir, great conversation as always. Thank you very much for joining in. Now, as promised, let's invite the management of Tata Power. Now, Q4 was a good quarter for them. There was an improvement in margins. Profitability too was higher. We have with us Praveer Sinha, Managing Director and CEO at Tata Power, now joining in. Mr. Sinha, morning. This is Reema here. My first question is on your capex. Now, FY26 capex was about 16,200 crore, while you had guided for 20,000 crore. So what led to the shortfall? Was there a delay in capex spend? And what can you guide on capex going ahead?
Good morning. Thank you for having me on your show. You're right that we had planned a capex of 20,000 in FY25. We could complete nearly 16,200 crores during the year. Some of our projects got delayed, especially because the evacuation lines for renewable projects, they got a little deferred, which of course will happen in the Q1 of FY26. Similarly, some of the projects of our transmission lines, which we are executing, there were issues about right-of-way, which now have been sorted out and will get completed in this quarter and next quarter. So I think it's just a question of timing, and we are very much on track to complete all these projects that have been planned last year and planned for this year.
All right, Mr. Sinha, hi, morning. Thanks very much for joining. And yeah, I guess that was one of the reasons behind the drag, right, at the top line level. On renewables, can you give us some sense of the revenue outlook? Is you're saying that a lot of these issues that impacted the performance in Q4, they'll get sorted out. So what should we expect overall from the renewable portfolio? Give us a sense of the revenue growth and also in terms of the capacity that you'd be looking to add in this particular year.
So last year we did a capacity add of nearly 2,300, out of which 1,000 was for our own project, that is the utility scale projects that we did. This year we have a much higher target, and those projects will get completed in this financial year. Also, last year we had for a very brief period the cell and module plant operating. And of course, the module was for a longer period, but the cell was for a very brief period. With only about 900 megawatt of cell we could manufacture. In FY26, we are expecting that this will cross 3,700. We also expect that our rooftop business, which has now really started pumping up. In fact, in last quarter, we saw the rooftop business doing a PAT of 100 crores. And if that trend continues, then we can expect a very high number in this coming financial year. So I think all these renewable businesses have started kicking in and has started yielding very good result. If you see on year, it was nearly 47% increase in PAT for a renewable business. This year, we can expect similar numbers for growth. So I think what you would see is a very stable performance from our renewable business. And there's not only the utility scale, but also in terms of manufacturing and rooftop.
Okay. Speaking of renewables, on solar, I don't know if you're looking at exports right now at all, because the big headline in the quarter was the U.S. imposing these humongous tariffs, right? It was almost, I think, some 3,000% or something on several ASEAN countries on, solar cells and modules, etc. Does that open up an opportunity for you at all on the solar side, exports?
Right now, we have our commitment to our own projects, which are supposed to be DCR projects. We have commitment to rooftop. as also some of the third-party EPC that we are executing, and we expect that we will complete most of them in next 6 months. And thereafter, possibly we'll look at the opportunity of exports. But I would like to only say that there are great opportunities within the country, even for third-party sale of just modules, because the DCR has kicked in various businesses, and there is a need of DCR modules. So I think we will weigh the options, whether it makes more business sense for selling within the country or we should export certain quantity. But we'll take a call maybe in the second half of the year.
But are you facing more competition, sir, in this particular segment? Some analysts are pointing that out, which has led to lower market share for you.
I don't think there is much of competition because the cell manufacturing is still very low. We are actually one of the biggest in the country in terms of cell manufacturing. And while a lot of capacity is expected to come in next 1 to 2 years, for immediate future, I would say that we have a very, very good market share. We'll be able to cater to that.
Okay, let's talk about the discom business, Mr. Sinha. I believe Odisha is working out very well for you, and that's partly responsible for the strong margin improvement as well that we saw in the fourth quarter. Tell us a little more about trends from the discom business for FY26. What should we expect? And the one that's of maximum interest for everyone, UP. What are the timelines there? I mean, I think you've expressed your interest in bidding as it opens up, but what are the timelines we can expect?
So Odisha has been a great experiment for us, and the type of service improvement, whether it is in terms of reliability, customer service, all that has improved tremendously. And many of the legacy issues which were there in terms of billing collection, we have been able to sort that out, including old payments which were due, but we were not earlier able to collect. Most of it we were able to collect in the last quarter. And this trend will continue because now the processes, systems, the IT support that is required for doing that is all very well established. And I do expect that Odisha will do much better result in the coming year because what we have seen in the Q4, similar type of results we can expect in the coming year, quarter on quarter. On UP, I think the government over there is very keen to pursue this opportunity of privatization, and the PPP model, as has been done in Odisha on similar lines, we expect the bidding process to happen. From what I understand, they have already appointed a consultant and the bid documents are expected in this month end. And possibly in this calendar year itself, the bid will get finalized. And Tata Power has the unique experience of both doing this type of distribution work in urban areas as well as rural areas, which many of the other private entities do not have. And I think we have an edge compared to anyone else.
So just coming back to that margin point, at the end of the fourth quarter, your EBITDA margin has moved up to as high as 19%. I guess the solar business is powering that. The Odisha discom business is powering that. Is that level sustainable? Can you give us some sense of the margin profile that we can expect this year, maybe first half of the year or the year as a whole? And whether, UP, if you get it, would it become a drag at least in the initial phase?
Well, we have seen that UP will come only in the later part of the year. But the margins that we have been able to improve, this has again been sustained over a period of time. And you have seen that every quarter we have come back with an improvement in our margins. And these are on very strong foundation. This year, our performance of our core business has been exceedingly good. And that is what is the big change that you would see in Tata Power, that how our core businesses have started now yielding very good result. And that's the way it is expected to be in future.
Sir, for a long time, you've always said that you're committed to not expanding your coal portfolio. You want to phase out your current thermal portfolio as and when the PPAs expire. And the end goal is that you should have zero thermal exposure by 2025. So while you'll still achieve it, but you are stating or indicating that you've not ruled out any opportunistic bid for stressed thermal assets. So the question really is that in the interim, what is going to be Tata Power's thermal strategy?
So as we have been maintaining, many of our PPAs have an end date. And as and when those end dates will come, we will definitely like to decommission those plants, and we stand committed to that. Secondly, we do understand that there is also in the short term a requirement of energy security. And if there is a very good proposal which is there, we will examine it. It's not that we have committed, but we will definitely look at it. If it meets our overall objective that by 2045 will become net zero. So that date does not change, and our commitment of 2045 does not. In between, if there is something that comes up, we can consider them on merit.
Okay. All right, Mr. Sinha, thank you very much for joining in and giving us some perspective on the business. Wish you good luck for the rest of the year. Well, that's Tata Power talking about going ahead and probably looking at the UP discom as well after the success that they've found in Odisha. Stocks down about 0.5% at this point in time. Well, we're staying with the industrial space. The next company on our radar is Hitachi Energy. The fourth quarter performance was another pretty strong performance, especially on the operational parameters. The margins were a beat on expectations, and the order book has seen a growth of 166%, and profit has also increased. We have N. Venu, Managing Director and CEO at Hitachi Energy, now joining in. Mr. Venu, thank you so much, and congratulations on another good quarter. Now, some will quibble and say that your top-line growth in Q4 is not as strong as what you've done historically. The top-line growth, I think, is about 11%. But obviously, those margins at 12.6%, they're looking spectacular. I'll start with the one main question. This HBDC order that you've bagged, this was a big announcement over the year that's closed out. Now, what is the revenue recognition timeline? I mean, over how many quarters? When does it start coming in? Yeah. And therefore, when will it start leading to, stronger revenue growth?
Sure. No, I think thank you very much having you in your show, and good morning to all of you. And as you have seen, our results, strategic focus, and also cyclical trends delivered a very strong quarter in a Q4. And if you really let me give a 30 seconds deep dive of our results. And our orders are up in the quarter almost 56%. Our revenue are up by almost 13% on year-on-year basis. And our margin in the quarter is up by 62%. And our operational EBITDA came double-digit, 12.3%. And this is also our full year performance. And if you really take the whole of year, our orders are up pretty strong, 228%, primarily bagging HBDC order and others as well. And revenue is up 23%.
Yes.
Whole year revenue up is a very strong orders. And we have been consistently saying in your own channel that we have been growing higher than the market on the top orders especially. And then once we have the order backlog, so naturally it will convert into a revenue over a period of time. And that exactly happened in that. But if I come back to your specific question on the HBDC order, which we have backed.
Recognition. Yeah. So we just want to understand, just for the benefit of our viewers, the revenue that you did in FY25 was 6,385 crores.
Right.
And your EBITDA margins were already at a multi-year high, 9.3%. So we just want to understand that as the booking of this HBDC order starts, how will the FY26 P&L profile look like? Revenue, margins, how does it change?
Yeah, as you know that we don't give you a forward-looking statement, but let me give you a little bit of marker so that you understand that. We have been consistently saying that we will reach a double-digit margin by end of this financial year. In the quarter, we have already reached here. And we said we will sustain that. Quarter by quarter can differ. But on an overall year, if you really look at the FY26, we said we will do a double-digit margins on that. Our HBDC's revenues this year is going to be a very small revenues. But in the year 27 and 28, we're going to have a bulk of the revenues we're going to realize in these two projects in that.
So, okay, so even without the, it'll be a very small trickle of the HBDC boost that comes in this year. Yeah. Even without that, you're saying margins will be in what, low teens? When you say double digit, what does that mean? Low teens, mid teens, some range?
We don't want to give a thing. I said we'll enter double digit and we'll sustain there. But again, I'm saying quarter on quarter might change. But on a year-wise, if you really look at an overall year basis, so we will I think sustain the double-digit.
Okay. All right, Mr. Venu. Good morning and good to see you. When you can focus on business, but the markets seem to sometimes take into factor in valuations. Could you explain why the stock is down 4% or thereabouts, but the performance has been good. Now, on your order book, you have disclosed it at around 19,250 crores,
right.
But you have not factored in the second HVDC order from the Adani Group, because I think that was signed in April 2025.
Absolutely right.
This will be accounted for in the first quarter of 2026. So if that is the case, back of the envelope calculation suggests it could be around 11,000 crores, which means your order book could be around 30,000 crores. Am I around about the correct numbers?
Yeah, if you the other order in the ballpark of 8 to 10,000 crores. So if you add that, so naturally it will be there.
Okay, all right. So around 30,000 crores, 30,000 crores is what we can assume, going by what you have disclosed and what you will disclose at the end of quarter one.
Exactly.
That's out of the way. Now, services is a smaller part of your business, but you've separated that as well. You've put it on, in your numbers.
Yeah.
How big can services become as a percentage of your business? And also exports, that's the other one that drives business, right?
Right.
How much will services scale up? How much can exports contribute to the pie? Because they are both margin accretive. Go ahead, sir.
So on there's two other levers for our growth, as well as both top line and bottom line, as the services and exports we have been consistently saying and consistently driving. Services right now is a single digit, and we have plans to take it to the mid-teens, maybe double digit. And we also talked about previously that the potential is based on our install base. We have a close to 2,000 crores order book possibilities there. It won't happen overnight, but we are looking at anywhere between 3 to 4 years' time. Today, we are around 500, 600 crores level of the service in that. So there is a potential. On the exports, if you take a last year exports without HBDC, our exports are in the 30-35% of our total orders. And we have been consistently saying that we would like to, in the range bound of 25-30%. We're already there in that. But we will add more and more exports. But our key focus is going to be a domestic market. We see a lot of pipeline, very huge pipeline, and not only on the renewable, but also on the transmission, but energy storage, data centers. All those things are a huge tailwinds for us. I think we are focusing. And you all know that we announced a 2,000 crores capex, and as we speak, and many of these projects are underway. So this will also add to increase our installed capacity in India.
In fact, I wanted to talk to you about your capex, 2,000 crore over the next 4 to 5 years. I think the cash in the books now is 3,800 crore. Is that correct?
Right.
So what lines are you adding capacity in? What will be the incremental revenue, the margin potential from your capex, and when will it come on stream?
Yeah. So again, it won't happen overnight. So we are talking about a 4 to 5 year thing, and there are many projects we are taking. For example, some of our large power transformer capacities we are adding, some of the very critical components required for the transformer insulation material, so that we are expanding it. Some bushings we are expanding it. Some of the new technologies, first time we are bringing it to India. For example, HBDC bushings is a very, very clear component, very important component. We are bringing those things. So these are all coming in a phased manner. And generally, our asset turnover is in the range of 3 to 4 times to start with, because they're quite a big capex, and then afterwards it might go higher in that. So it is coming in a phased manner, and we are on track as far as our planned capex is concerned. And we see that in the next 4 to 5 years we complete what we have committed, what we have promised.
Just a quick word on the data center opportunity. Will you be able to quantify?
No, data center is quite a big opportunity. Every data center.
But for you, will you be able to put a number to that? We know the total addressable market is huge.
I'll tell you, our addressable market in every data center capex 15 to 20%, depending upon the hyperscale. Every hyperscale coming into the picture, 15% of the data center capex is our addressable market.
And how much will you be able to realize?
As we speak now, every 1 out of the 3 data center is powered by us, especially on the grid connection and on that. So we are looking at to maintain that our market share.
Mr. Venu, I'm just going back to HBDC for a second, sir. This 30,000 crores of rough order book, if we count in the April, so as of today, if we talk about it, roughly 30,000 crores.
Yeah.
What is the split between HBDC and non-HBDC? as of now? Just percentage, rough percentage.
As I said, as we speak, as of end of this last financial year, our order backlog is 19,245 crores, and the new order we have booked only in the month of April, so which we're going to tell you after the end of the quarter closure. But on the 19,245 crores is the only one HBDC is sitting in this thing. The rest of the things is non-HBDC, like your data center, industrial things, services, exports, etc.
No, what I'm trying to now get at is that two-part question. FY26, what is the, and you'll eventually book this one, and I don't know if the third HVDC order, whether that comes up for bidding this year itself or not. Yeah. Just tell us that. And, by the end of this year, what will your mix be between HVDC and non-HVDC?
No, we don't do that way, mix, because HVDC is also one of our levers. It's not the only one, because take, for example, HVDC, all our 4 business units portfolio go into this particular project. So that way, we make separate HVDCs are separate, and that way we don't treat that.
You don't bifurcate that. Okay, and I get your point that FY26, you said it'll be a very small, quantum of revenue that will be booked. If you could give us some sense, and then just give us some sense of FY27, because the market discounts the future, right? We're just trying to understand that from a P&L standpoint, what kind of revenue will be booked in FY27 from this large HVDC chunk that you have? Let
me give you a little bit of marker for you to understand. The HVDC projects normally we complete in 48 to 54 months. So 48 is the first bipole, and 54 is the second bipole in that. So normally in the first year, we do a lot of engineering and the small revenues. So that will be very small percentage, low single digit in that. The second year will be slightly higher, and the third year is where the bulk of the revenue comes in that.
So FY28 is where the bulk of the revenue comes
27 in. Also, 27 second half also is quite a thing, and 28 will be definitely much higher.
All right.
Understand these 2 projects has around 6 months delay, so naturally that particular revenue delay also will be.
Okay. All right. Mr. Venu, very quickly before we let you go, small nuclear reactors, well, that's been in focus in India as well. Now, your parent, Hitachi, has globally very strong nuclear capabilities. If and when this opportunity opens up in India, will it be pursued under the listed entity, Hitachi Energy India?
See, Hitachi Energy India, what we do is whatever is required for the, this nuclear thing we do, but not on the technology standpoint, is a separate company.
Okay, so then it would not entirely come under this entity, right?
Yeah, but what is required for that, powering the nuclear thing, like, offshore and auxiliaries, etc., will come from us.
Okay, all right. We'll press you a little bit more on this. But thanks a lot for joining in. I recall when I visited your unit, you all were gunning for double-digit margins. Now margins are improving. Exports and services are going to be a larger share of your contribution, which will help profitability. Thanks a lot for joining in, Mr. Venu. Looking forward to chatting up with you as the year progresses. For the time being, slip into a short break. On the other side, we'll be joined by the management of Muthoot Finance. Stay with us.
Welcome back. Now let's invite the management of Muthoot Finance. The stock is a bit under pressure despite a decent set of Q4 numbers. The AUM saw a growth and they've maintained their gold loan guidance for FY26. George Alexander Muthoot, Managing Director at Muthoot Finance, is now with us on the show. Thank you very much for joining in. Well, sir, you're talking about a minimum growth of about 15% for FY26. You have also kept the option open that you will revise it higher. But, considering that you achieved a 40% growth last year, a minimum 15% appears to be a bit conservative. Tell us what's gone into this guidance and what could be the realistic number. Already we are halfway through Q1.
Thank you. Thank you and good morning. Over the last, maybe to my remembrance, maybe last 10 years, we've always been giving the guidance of 15% only. But always we have been achieving 20, 25, 30, and last year 40%. So it is just a number that we give in the beginning of the year. Probably we will revisit it. We will look at it probably after Q2. We will revisit the guidance number also. But the market is good. The business is good. We see good growth coming in this year also.
Are you worried that a lot of your AUM growth is driven by the rise in gold prices? If gold prices retreat, and we've already seen gold prices come down, cool off a bit, is there a risk to your AUM growth? On the AUM front, how are you seeing this volatility surge, then risk of a cool off in gold prices? And what could your AUM guidance be?
Yeah, there are always fluctuations in gold prices. Maybe goes up, goes down. But over the last years, it has always been going up only. But of course, in the last 6 to 7 months, it has gone up too high. Probably it may cool down a bit. But of course, we give only 75% of the current value. And that also is a 30-day moving average. So today, if you look, our gold loans advance which are given, it's only 62% of today's price. If you look at the value of the gold we have with us and today's gold price, it's only 62%. So that is the margin or the headroom we have. So some corrections in the gold loan will not be affecting us. Second, as always, we have seen so many such cycles. We have seen the cycle of gold price fall in 2013, 14, and occasionally over several years, you see some months of gold price fall, etc. But people don't abandon their gold. So gold price is not a big factor. But having said that, why the business is going up is mainly because of the demand for funding. The unsecured loan sector is the people are not getting the money they required. So people are using gold loan, and banks are also doing it. The pie is increasing. More and more people are actually looking to gold loan for a quick and easy finance. That is why business is growing. Of course, gold prices help because they don't need to bring extra gold. With the same gold, they can get more and more money.
Okay, so as of today, as on today's prices, you're maintaining about a 62% LTV, right? So we got that.
So I think not the exact number, maybe 60,
around that.
What we have given. Yeah.
Around 60%. So give us a sense. I mean, the fourth quarter, obviously, it looked absolutely, it was an outlier, 40% growth in AUM because of the way, gold prices move. But steady state, what is the AUM growth in the loan book that you're expecting on the gold business this year, FY26?
That's what I have been saying. We will get good business, but don't be carried away or don't be concerned with the ultra conservative guidance which you are giving. We have 5,000 plus 6,000 branches in Muthoot. So people are there, the money is there, requirement is there, our branches are there, staff is there. This will go up only.
Okay, so you're just being conservative. You're admitting you're being conservative at 15%. All right. So just a word on cost of funds as well. How is that moving? Because I think for you, the NIM quarter on quarter, there was a little bit of a pressure that was coming in. But now there are a lot of moving parts. I mean, we are in a rate cut regime from the RBI as well. What are you expecting on cost of funds and NIMs over the next couple of quarters?
So we have been maintaining our spread. NIM should be about 11%. Spread should be in the 9.5%. I think in the last 4 or 5 quarters, our spread has always been 9.15, and we actually maintained it. If the cost of funding goes up, we try to absorb it for 1 quarter or so. Afterwards, it's still going up. We increase our yield, but we maintain our spread. The same thing if the cost of fund. Today, the cost of funds is coming down a little. So it will take for a few months for it to maybe stabilize. If it is really coming down, we will reduce our yield, but maintaining our spread. So if there is an advantage in the borrowing cost, we pass it on to our customer. That is what our NIM and spread, etc., have been almost constant in the last several quarters.
You just spoke about
the cost of operations. Yes, the new
guidelines. Go ahead.
Yeah. Yeah, all the new guidelines, the compliance cost is also going up. But only advantage with Muthoot is that our per branch business is also going up. So in that respect, our cost of operations will stabilize. So last year, our per branch business is about 15 crores. Today, it is about 21 crores. So that will help in maybe absorbing some of the extra, compliances cost, etc.
Can it go higher than from this 21 crores? If yes, what is the kind of outlook?
Definitely, it should go up. That is why we are all here.
To what? To what level, sir? If you have a target, as you're saying, you've been ultra conservative, stock is down 5%, you're on the best business news channel and everyone is hearing, you can go ahead and up the guidance as well, sir. Do you want to do that?
So I think a branch, it was 15 crores last year, it was 21 crores this year. I'm sure we have branches with 50 crores, 60 crores, 70 crores also. So optimistically, all the branches can reach 50, 60 crores.
Okay, all right. But you want to up the guidance from 15% that you've given conservatively?
Not today, sir. Maybe after Q2.
Very quickly, you mentioned about yields. There could be some pressure there because competitive intensity could come back. PSUs, banks, they are eyeing this gold loan market share as well. And now Manappuram, that's been, not really a big competitor to you. They could pull up their socks because Bain has come in. A quick comment on competitive intensity and could yields come down from the current levels? I think it's ballpark around 18%.
I think I just mentioned that if the cost of fund is going up, we will increase our yield because these are all small loans. The 20,000, 30,000, 50,000, 1 lakh, and 0.5% increase in the yield will not maybe change the sentiment of the customer because it's a quick loan, short-term loan, 2 months, 3 months, 4 months. So in absolute terms, the interest payment is not much. So if the cost of fund is going up, we actually increase our yield. We have been maintaining our spread and net interest margin spread of about 9.5% is what we have been maintaining all the way. And we should be able to maintain that. Competition intensity is there. It is because this is a good sector. Everybody wants to enter there. But the pie is also growing. It is not that we are the only ones who are growing at the cost of somebody else. Yeah. Banks are also having 20, 30, 40% gold loan in their growth in their gold loan portfolio. So if everybody is growing, the market is increasing, sir.
Okay. All right. Good speaking to you, Mr. Muthoot. You're not taking the opportunity this time around to go ahead and increase your guidance. We'll chat soon. Maybe that's the time you'll go ahead and up it. Appreciate you joining in. Let's focus on the cement pack then. We have Neeraj Akhoury, the Managing Director at Cheese Cement, who joins us on the show. Hi, Mr. Akhoury. Good morning and congratulations on a good set of numbers. What's the strategy going to be, sir? Volume growth actually has been lagging the industry, at least in the past year, but pricing has improved and profitability has improved. For this year, what kind of a volume outlook do you have? Point number one. And premium as a percentage of your trade mix, that's moved up. Where is that number headed from around the 15% mark?
Good morning. I think as we always have liked to believe that the cement demand growth would be in line with the GDP. If we are expecting the GDP to grow by 6 to 7%, then to my mind, cement demand growth will also be around that, 6 to 5%, 6 to 7%. Yeah. For us, we would be adding some new capacities this year. We have already added 2 plants this year, and we will be adding 2 more in the coming quarters. And that should give us a volume which will be slightly higher than the industry average, industry growth. That is how I see. On premium, we have been working on it. We've already reached from 9% to roughly about 15.5% now. And this trajectory will continue. We expect it to touch somewhere around 17-18% soon. That is a trajectory that we have decided. The focus is on profitable growth. The focus is how to make sure that our efficiency parameters as well as our pricing works well for our results.
Okay, so high teens is what you're gunning for in terms of premium as a percentage of your trade mix. Got that. And on volumes, we are working with 6-7% growth for the year, a GDP growth that is 6.5% or thereabouts. So, and normally, as you said, cement grows at a faster clip. So for your company, sir, after underperforming in the last year, this year, fair to assume 9 to 10% volume growth?
No, I would rather keep it at 8% for now.
8%, you're being conservative because I'll hold you at this number as well the next time around you join in. Got that. On the cost side, you have been focusing a lot out there. And if I look at it, green power, the share is at around 60%. It's the highest in the full industry. And that's moved up. Where do you see this number headed? And since you have cost levels in place, what does it mean in terms of an EBITDA per ton? For the year, you were at around 1,000 rupees or thereabouts. This year, what is the range we can work with?
So it's not right to give me an estimate like Nigel, but I would say that given that we are having better prices than what we had last year in the same quarter, along with the fact that some of the costs continue to decline, including the fuel prices, we expect that the fuel prices will at least remain at this level and not go up. In that case, I would say that the EBITDA would be in there. Should be better than what we have seen for full year last year at 1,000. But we'll not be able to give an exact number at this moment.
And DAM Capital is saying by FY27, they're expecting the number to go to 1,370. You agree?
Let's see. It's too early in the year. It's just quarter one of the full year. Let's see. Yeah.
And green power is a percentage of the mix. Where does it go?
We are working a lot on the green power, and 60% is what we have achieved. Happy to note that we are one of the best in the industry, most probably globally as well. And I would expect this to go up. We are already working on some more sites across the country, so it should go up in the coming quarters.
Mr. Akuri, you all will have to do something more exciting now, because I mentioned this to Mr. Bangur as well. Shree Cement always gets the best valuation in the full cement pack, because of the ROC. You all were the first ones to get into petcoke, all that taken on board. But Street is looking for something more exciting. What is that going to be from here on? You're sitting on cash of around 5,400 crores, which is a good amount. You have a capex plan of around 3,000 crores for this year. Some kind of inorganic growth could be the trigger. Are you looking?
Nigel, as I said, we are very intensely focused on being the most profitable cement company in the industry. And that is something that we would like to fiercely protect in the coming quarters and coming years as well. We have a lot of plans on organic growth. We have a plan to reach 80 million tons by FY28. And with that ambition, I think through organic routes, we will reach there. We are not against any inorganic growth. But it should make sense to us in terms of valuation, in terms of strategic fit. But currently, the focus will remain on how to reach 80 million tons on the organic route.
You have, you're currently in that vicinity of around 60 to 63 million tons.
Yes.
And I think what's on the drawing board is to reach 70 million tons. So from 70 to 80 will all be organic. Is that part of the plan as of now?
Yes, absolutely.
And you mentioned a couple of times that profitable growth is something, you want to be the low cost producer and in turn, focus on profitability. But if it's a toss up between profitability and volumes, what you'll choose? Because last year volume growth was very, very low. It was low single digit and you lagged the industry. So a toss up between the two, which one are you selecting, Mr. Kuri?
We are very clear that value is what we should be chasing and not just volumes. Volumes are important, but at the same time, we would be following that. How can we get more profitable growth and not just volume growth?
Okay, all right. Profitability over volumes. We got that on board. We'll hold you to a few of these numbers. Thanks a lot, Mr. Kuri, for joining in and detailing those set of numbers and the way ahead.
Pleasure.
By the way, when we're having the chat with the managements of Muthoot as well as Shree Cement, the markets are actually down close to under 150 points. Number of stocks advancing still more than the number of stocks declining, though in fact the Midcap index is almost moved into the red. Slip into a break, come back. Manisha Gupta will be joining in to tell us what's going on in the commodity space.
Welcome back. Down 0.5% now on the benchmark indices. Let's find out what the situation is in the commodity markets and what the rates look like. Manisha.
Thank you for that, Rima. It's profit-taking across commodities as well. And I want to start with the gold prices because we saw all-time highs here when we saw those tariffs come in, and $3,500 an ounce of an all-time high is what the gold prices hit. Well, since it has been U.S. and China trade agreement, even if it's temporary and for 90 days, we have seen that constant profit-taking continue in case of gold prices. So 3150 and below that is how the gold prices are trading now. It is a 5-week close coming in for the gold prices. Let me still remind you that for the year, we are up by nearly 24%. And for the last 12 months, it still is 40% higher for the gold prices. But from its all-time highs, the gold prices now have declined by nearly 10%. So huge profit taking coming in, and this is in less than a month that we've seen the gold prices see that kind of a decline there. Well, one is, of course, the focus has shifted away from the safe havens, it's risk on, and we've seen money flow into various other asset classes. And majorly, it is profit taking because the street believes that various cues, the reason that the gold prices went higher, seem to be easing off now. One, of course, is the U.S. and China trade tensions, though it seems to be diminishing right now. And then the U.S. also has been reiterating that the trade agreements are processing well from various countries like India, Japan and South Korea as well. The third point really is about Trump lifting sanctions on Syria. This was announced in Riyadh when he was visiting Middle East, and that also has eased pressures a bit. It also is about India-Pakistan tensions not escalating, stabilizing even. And then it also has to do with the softer than expected U.S. inflation numbers that also have led to this decline in gold prices. But it's not just gold. If you look at silver prices, they also fell 2% in the overnight markets. We are trading at a 1-month lows for silver as well. So when you look at on a week-on-week basis, we have seen the gold prices decline by 5% and silver is down 2% in the same time as well. And it's not just about the precious metals. The industrial metals also have seen a sharp decline. Whether it is about copper, aluminum, zinc, we have seen prices decline. And if you look at the crude oil prices, there has been a very sharp cut coming in for this as well. It has been 2% of a cut on 2 days now come for the crude oil prices. And with that, now we are off those 2-month highs that we were trading in. Well, the major factor here also is that Iran has said that they are ready for a nuclear conversation. Remember, there has been 4 rounds of talks there. And Iran also says that once the sanctions are taken off, they can talk about nuclear deal here. So there seems to be some progress in conversations coming in there as well. Apart from that, when you look at the U.S. crude inventories, well, they also have seen a surge by 3.5 million barrels. Street was anticipating a 2 million barrel of an increase, so that has been weighing. And then you have the OPEC trimming supply growth from non-OPEC countries, suggesting that if the crude oil prices stay where they are, then for U.S. and for the non-OPEC countries, it wouldn't be very profitable to continue to produce crude at these current levels. And then U.S. OPEC and oil supplies also have been increasing, even as OPEC is looking to increase production for the month of May and June. We have seen some internal disparity not continuing to work there, and that seems to be weighing onto the markets there. So whether it has been about precious metals, industrial metals, energy prices, all of that has started Asia on a weaker note today. What the markets will want to watch out from here is the US PPI numbers, and that would give you further direction from here.
Thank you very much for that. And Reliance Industries Chairman and MD Mukesh Ambani went to Qatar to meet the U.S. President Donald Trump, who is on a tour of the Gulf nations. You can see the visuals on your screen. Mukesh Ambani also met the Emir of Qatar. This is Reliance's chairman's second meeting since Trump's return to presidency in January this year. Okay, still down more than about 100 points on the benchmark indices. Reliance Industries share price is down more than about 0.5%. Also under pressure, you've got Power Grid, Dr. Reddy's, NTPC. So power is cooled off today. Some of the pharma names are weak. So we spoke about Dr. Reddy's, but other than that, you've got Cipla, and banks continue to tread with weakness. Yesterday, the Nifty Bank underperformed, and today as well, the Nifty Bank is down close to about 250 points. Midcaps are relatively outperforming. No gains to boast of. The midcap index is up 0.1%, but at least there is that relative outperformance. Advanced decline ratio in favor of more stocks advancing. With that, we'll get into a break. We'll come back with our special segment, Indianomics, on the other side, where Lata speaks to Neeraj Seth, CEO of 3R Investments, on Asian currency and credit markets.
risk markets have clearly come a full circle. So is the worst of the reciprocal tariff scare behind us? That's the question we're asking in today's Indianomics. Now watch this, the table that will come up for you. Pre-April 2nd, that is the pre-reciprocal tariffs, the US indexes, say S&P for instance, was at 5670, Nasdaq 17,150 thereabouts. Post-reciprocal tariffs, they fell about 15%, as you can see. And now, after the U.S. China deal over the weekend, they are back above their April 2nd levels. Likewise, you can look at the Nifty, or you can look at the dollar index. The Nifty as well, 23,350, falls about 15% after the reciprocal tariffs, and now back above the April 2nd, or back above the reciprocal tariff levels. Likewise, for the dollar index, it's not quite climbed back to the pre-reciprocal index levels, but the rupee definitely has. It fell to a low of 86.50. Gold is the other way around. Gold being a haven when risk aversion is high. It was high during the time. It was low during the pre-reciprocal tariff. After the tariff, because risk aversion was at its height, gold went to a high of 3,500 and now is back to the pre-reciprocal times level. So the question we are asking is the worst of the tariff threat over? And if yes, which assets will smart money chase? First, I'm joined by Neeraj Seth, founder and CEO of 3R Investments and formerly head of fixed income at BlackRock. Neeraj, thank you very much indeed for your time. That really is the first I'll ask you the big question and then come to the nitty-gritties. Do you think the markets have priced the worst of risk aversion?
I think the markets certainly have priced out all of the risk from the tariff and more. Obviously, there's an element of positioning that plays a role here, but I do think looking at the 120-degree turn, not 180, from President Trump, I do think the worst of the tariff scare is behind us. It's not done, it's not over. And the fascinating thing is that the investors are actually celebrating a 10% across the board tariff and still the remaining uncertainties in front of us. But it's not as bad as what we saw on April 2nd.
Yes, I agree that it is 120-degree turn and not a 180-degree turn because the president has said this is a 90-day truce. But is the market seriously pricing in something worse than 30% tariffs on China or a return to very high tariffs?
So I do think the markets, in fact, are moving more towards pricing even below whatever the last number, around 30, that was in the news, for a simple reason that in any negotiation, if you start from 0 or whatever the last number was, or 10, that cross-the-board tariff versus 30 as the discussion point, the markets would expect the meeting point to be somewhere in the middle. So the pricing that I see at this point actually is reflecting a better outcome than even that 10 and 30 that obviously President Trump has been talking about.
Okay, let me ask you some unfair questions first. You are a fixed income expert, but I'm going to ask you if the best of gold is over for the moment. If risk aversion of the worst kind is already priced in, then gold doesn't go back to $3,500 for now?
If I have to predict, gold will go back to 3,500, but it'll take time. Part of the reason, exactly what you said, the near-term risk averseness and the uncertainty has come down, which is bringing gold back down. But if I take a step back and think about the world that we live in and the global reserves that sit in US dollars, the exposure the world has in US dollars, I do think the systematic reallocation is still going to happen over the coming years, and gold will be one of the beneficiaries, whether it's in the central bank portfolios or individual portfolios. So it's going to be a structural bull run, but a cyclical correction that we are going through. And I do think right now, near term, you probably have more to correct on the gold, given the uncertainties coming down and market is pricing the other side. But longer term, I still think gold will go higher.
Okay, so that is something like a buy on dip strategy that you're giving us. Okay, let me come to now the Asian, where smart money will go. Do you think now smart money chases risk assets like equities?
I think there is some reallocation happening. There's also, as I said, the technical backdrop of positioning. The CDAs were short given post the moves in the market post April 2nd. I think that readjustment is happening. I do think the smart money will still look at more diversification, first of all. Very high concentration that you see at this point in the US equities and US tech for a number of investors. So I think diversification is going to be one element. And if I take that lens, and think about the markets that will benefit. In my view, Europe will get a little bit of that reallocation benefit. Japan and India, in case of Asia Pac, will get that benefit. So you will see some of that money flowing back in these markets.
Okay. Now let me come to credit. India, even at the worst of times, continued to receive money in the bond funds. I think there was practically a couple of weeks when we didn't get, otherwise money was coming. How will bond funds look at Asian credit and particularly Indian credit?
So broadly, the Asian credit, I would say, is at this point fairly priced. I do think the spreads have a risk of widening, and because credit is not an asset class that loves uncertainty, and that's something which hasn't gone away from the market. So credit, I think, still has a little more risk of widening if you take a 6 to 12 month view. India is slightly different, and part of what we have talked about in the past, that when you look at the Indian markets, one, you have a fairly big high-quality market, including the government bonds, PSU, and small corporates in the capital market perspective. And then you have the growth of private credit markets. And the global exposure, the foreign exposure in the India onshore story, despite all the news flow, is still not very high. So I do think India will continue to see those flows on a structural basis, at least for the foreseeable future.
Oh, yes. We also got a lower than expected inflation number for the 4th month running. So there are other reasons why Indian bonds are looking very attractive, even for domestic investors. But coming to the one, asset class which has defied all the risk move up and down, US bonds. I mean, 4.53 after you've seen what one must say is, some end of uncertainty. What explains the rise of US yields?
Well, part of it is obviously the markets are going through the respite, and hence you are seeing the sell-off in the bonds, which had a little bit of a tailwind or a support because of uncertainty and the risk of recessions that the markets are pricing in. Okay. And equally importantly, if we look at the fiscal financing and the monetary policy path, I still think there's a challenge there. On the fiscal financing, US still has a fairly heavy fiscal financing with close to $2 trillion of deficit that needs to be funded this year, and it's not coming down anytime soon. And on the monetary policy path, which is even more complex, I do think the Fed is sitting in the middle of very dense fog of uncertainty, both on the inflation as well as the employment front. So it's going to be hard for the Fed to move. Their best case scenario is to sit and wait. So between the financing, which is pushing the term premium higher, and the Fed uncertainty or the lack of Fed moves, which is keeping the front end also pricing out a little bit of the rate cuts. I think looking at the curve, the way it's behaving, I'm not at all surprised. If anything, I do believe the long end can actually keep backing up more.
Oh, going towards 5, you think?
I think 30-year crossing 5 is, well, we're not very far to begin with, but I don't think that should be a surprise. You still, when you think of fiscal financing, end of the day, the clearing price is a function of supply, demand, and where obviously you could get the investor interest. And the foreign demand is, although hasn't gone away, but it's not as strong for the US treasuries at this point.
Okay. Time permitting, I wanted to ask you a little more about US treasuries, but let me come to the dollar index. We have seen the dollar index recover somewhat from the sub-100 levels, but give us your view on whether dollar strengthens from here on, and therefore the dollar rupee in particular, not other Asian currencies.
So medium horizon, I'm still in the camp of dollar weaker. And that's mainly to do with more of the flow picture that you see on the back of the tariffs, the global exposure to the US assets, which is north of $30 trillion in the liquid markets. And hence, as some of that reallocation happens, I do think the dollar still has potential to weaken further. On the dollar, INR is interesting because you have, in addition to what happens to the dollar, you have RBI sitting on the other side. I think that stays more sideways with potentials, like, if anything, over time, some strengthening driven by the flows.
Okay. Well, some strengthening because of the flows, yes. Neeraj, now a big question. We may not have time to flesh it out completely. Do you think the next big problem for all financial markets will not be the end of this 90-day period, but potential tax cuts by the US government, which perhaps is just a few weeks down the line?
So interestingly, that's an important point because the market can normally focus on only one thing at a time. And that focus will go towards tax cuts as we cross middle of the year. So you're right. I think that focus shift will happen. That also to some extent keeps the tailwind for the markets in the near term, because obviously the regulatory aspect and the tax cuts still have a bit more of room for the tailwind to be there. So I think that will move. Now, the interesting thing will be, I would say the bigger point the markets will focus on as we get into July will be the earnings from the second quarter, because the uncertainty that got created was April 2nd onwards, which is not captured at all in the first quarter earnings. So the second quarter earnings, you start to see a little bit of initial impact of these changes. And I think that will be more important in my view.
Okay, then a quick last question. Because of that, will US exceptionalism fade or will it rise?
I think
because of the tax cuts.
I think on the margin, the US exceptionalism little bit fades, partly to do with obviously the policy uncertainty that has been created. But when I look more from a corporate perspective in terms of innovation, growth, the technology aspect, the overall focus on shareholder value creation, the depth of the capital markets, I think US still remains an important market. It's more a question of how much exposure a non-US investor should have in that market. But it doesn't change the focus on the return on equity and the shareholder value creation that we have seen over the last 40 years.
Okay. Well, out of time, thank you very much for joining us, Neeraj Seth. But we will pursue this theme of whether the worst of the reciprocal tariff fear is out of the market. Thanks much for watching this edition of Indianomics. We'll be back with Chartbusters.